Shaily Engineering Plastics, a high-precision polymer processing player, has reported weak Q3 numbers. A growing order book in home furnishing, impetus towards efficiencies in the medical segment, and a steady demand trajectory in the other verticals would be the key factors to watch out for. Let's do a three-point analysis of the earnings fine print. 1. What are the highlights of Q3 earnings? Well, Q3 results had more negatives than positives for sure. Gross margins expanded because of pass-through of raw material costs. Now, sales growth was slower year-on-year because of delayed orders and change in the inventory policies. Operating margins contracted due to lack of operating leverage and higher investments for the new orders. Profit margins dipped because of lower other income and a substantially higher tax rate. Finance costs increased since debt was taken for funding land acquisition and also other capex requirements. The target to achieve revenues of $100 million has been postponed by a year to FY21 end. 2. What are the other key observations? Well, for one, Swedish home furnishing major has planned to invest 10,000 crores in India over the next 5 to 6 years. Now, this assumes importance as 50 to 60% of Shaily's revenue is attributable to the Swedish home furnishing major alone. Now, Shaily will commence supplies of carbon steel furniture to the Swedish company from October 2019. The management also expects sales of over 100 crore rupees from this project alone. Starting Q4 FY19, Shaily will also start earning revenues from a large Europe-based global departmental store. Now, demand for medical packages is on the rise as well. Now, in the auto segment, the use of plastics is on the rise within and outside of India. High demand for FMCG and LED lighting will positively impact Shaily's businesses. Labor and power expenses are expected to normalize in the next 2 to 3 quarters, and consequently, the strain on margins should also reduce further. 3. What are the key risks and outlook on the company? Now, delays in project implementation from the client's end may restrict top-line growth. FY19 will end on a subdued note because of sluggish growth in sales volumes. The stock is close to its 52-week low as well, trading at 20.2 times its FY20 projected earnings. Any meaningful uptrend in valuation multiples may be visible only from the second half of FY20. That is when incremental orders in home furnishing start translating into revenues.